Hello, my name is Robert, and what I'm about to show you is going to completely change how you think about the metals market right now. It's January 23rd, 2026, and I need you to understand something critical. While everyone is watching silver get absolutely demolished, while gold is sliding, while the financial media is screaming about the death of the commodity supercycle, there's one metal sitting there with the kind of stability that should make every serious investor stop and pay attention. Copper, $5.86 per pound, holding the line like it's welded to the floor. Now, I've been in these markets long enough to know that when there's a disconnect this massive between what your screen is showing and what the physical market is actually doing, you need to pay attention. Because the screen can lie, sentiment can shift overnight, paper contracts can be printed, but you cannot print copper mines. And right now, while the retail crowd is panic selling their precious metals positions, while the fear merchants are calling this the great metals crash, something extraordinary is happening in the shadows. Amazon Web Services just bypassed the entire public market to secure copper directly from Rio Tinto, a 2-year direct offtake deal, not through the London Metal Exchange, not through COMEX, direct. Samsung's doing the exact same thing. So let me ask you something, and I want you to really think about this. If copper is just another industrial commodity that's about to crash with everything else, why are the biggest corporations on the planet locking in multi-year supply contracts right now? Why are they willing to pay above market rates to guarantee delivery? The screen is telling you one story. The shadow market is telling you something completely different. The thesis. Here's what I need you to understand clearly, because everything in this breakdown builds from this single point. Copper is no longer just a commodity, it's becoming a strategic tech asset that Amazon, Samsung, and every other major player in the AI and electrification space are securing before the public markets even wake up to what's happening. This isn't about short-term price action. This isn't about riding some hype wave. This is about recognizing a fundamental shift in how the world's most critical infrastructure metal is being valued and allocated. We're witnessing what I call the great decoupling. Silver and gold are being treated as fear trades, as insurance policies you buy when you think the system is breaking. And look, I get it. I've stacked physical silver myself. I understand the appeal completely. But copper? Copper is being treated as infrastructure oxygen. It's the metal you need if you're actually building the future. AI data centers, electric vehicle fleets, renewable energy grids, high-speed rail infrastructure. Every single piece of technology that's supposed to power the next 2 decades of human civilization requires massive amounts of copper. And here's the uncomfortable truth that mainstream financial media absolutely does not want to talk about. Supply cannot respond to this demand for at least a decade, not because of some temporary bottleneck, not because of a logistics hiccup, but because of the fundamental physics of mining itself. It takes 12 to 15 years to bring a new copper mine online from discovery to production. Ore grades have dropped 30% since the year 2000. The easy copper has already been pulled out of the ground. And meanwhile, demand is accelerating at a pace that would have seemed absolutely insane just 5 years ago. What's happening right now? Let me give you the exact snapshot of what the market looked like just hours ago. January 16th, early afternoon Eastern Standard Time. Gold, $4,588, down $21.84 on the day. Silver, $28.55, a brutal minus 3.15% dump. This is the kind of move that makes retail traders question everything they thought they knew about their positions. Copper, $5.86 per pound. Now, here's what's critical about that copper price. While precious metals are getting absolutely hammered, while the headlines are screaming apocalypse, copper is holding firm. Not rallying, not mooning, just holding. And in a market like this, that stability is more telling than any moonshot could ever be. When you look at the CFD structure for copper, you're seeing a high liquidity battle zone at $5.86. Despite the panic dump in precious metals, despite the broader risk-off sentiment, despite every reason for copper to be selling off in sympathy, it's refusing to surrender that $5.50 to $5.80 structural support level. This is what I call tectonic stability. It's not flashy, it's not exciting for the day traders, but it's the kind of price action that tells you there are very large hands underneath this market who are absolutely not willing to let it break lower. Contrast this with what's happening in silver. Silver is experiencing what traders call a red flush. It's emotional, it's volatile. It's driven by paper traders who are selling out of fear, who are responding to headlines, who are trying to front run what they think is a broader metals crash. But here's where the paper market and the physical market are telling you two completely different stories. While paper traders are dumping silver contracts, physical giants like AWS are signing 2-year direct offtake deals with Rio Tinto for copper. Think about that for a second. Amazon Web Services isn't speculating. They're not trying to flip a commodity for a quick profit. They are securing multi-year supply contracts because they have done the math on exactly how much copper they need to build and maintain the data center infrastructure that powers their entire business model. And they are willing to bypass the public markets entirely to guarantee that supply. This isn't normal behavior during a commodity boom. This is a highly unusual behavior during what the mainstream is calling a commodity crash. So you have to ask yourself, what do they know that the paper markets don't? The macro rotation. Nobody's watching. I need to slow down here because this next part is the foundation for understanding why this actually matters. We need to talk about the copper to gold ratio. I know ratios sound boring. They sound like something from a textbook that puts you to sleep. But this ratio is the economic seesaw. And right now that seesaw is tilting in a direction that most people are completely unprepared for. The copper to gold ratio measures the market's preference between two fundamentally different types of assets. On one side, you have gold, the ultimate defensive asset, the emergency fund, the insurance policy. On the other side, you have copper, the industrial workhorse, the infrastructure metal, the thing you need when you're actually building the future. Gold is what you buy when you're scared, when you think the system is breaking, when you don't trust currencies, when you want to preserve wealth in a form that has held value for 5,000 years. Copper is what you buy when you're building, when you're laying electrical grids, when you're manufacturing EVs, when you're constructing data centers and renewable energy infrastructure. You buy insurance when you're scared. You buy wiring when you're building the future. So the ratio between these two metals tells you something profound about where the market thinks we are in the economic cycle. When the copper to gold ratio is falling, it means the market is rotating into defense. People are scared. They're buying gold. They're selling industrial metals. This typically happens during recessions, financial crises, periods of extreme uncertainty. When the copper to gold ratio is rising, it means the market is rotating into offense. People are building. They're investing in infrastructure. They're betting on growth. And here's the trap that most precious metals holders are walking straight into right now. They've been conditioned to see gold and silver as the ultimate safe havens. And in many scenarios, they absolutely are. I'm not disputing that. But when the ratio starts to turn higher, when copper starts to outperform gold, it signals a shift towards cyclical industrial utility assets. And if you're holding only defensive assets during that shift, you're positioned for the last war, not the next one. Let me show you where we are right now. The copper to gold ratio just completed what Elliott wave theorists would call an ABC flat correction. For those who don't speak technical analysis, that basically means the market spent months digesting previous gains, consolidating, building a base, and that correction, it just ended. The seesaw is tilting. Now, I'm not saying gold is going to collapse. I'm not saying silver is dead. What I'm saying is that the market is starting to favor the metal that represents growth and infrastructure over the metals that represent fear and preservation. And this shift doesn't happen overnight. This is a slow, grinding rotation that can take months or even years to fully play out. But the early movers, the institutions, the tech giants, the companies that are building the infrastructure of the next decade, they're not waiting for CNBC to confirm the trend. They're positioning now, running the numbers. All right, now we need to run the actual numbers, because if I can't show you the math, then this is just another hot take in an ocean of financial noise. Let's start with the demand side, specifically what I call the EV and grid gap. A traditional internal combustion engine vehicle uses about 20 kilograms of copper. That's your wiring, your starter motor, your alternator, basic stuff. An electric vehicle uses approximately 80 kilograms of copper. That's 4 times the copper intensity per vehicle. And we're not talking about some marginal shift in the auto industry. We're talking about every major automaker on the planet committing to full EV lineups within the next 10 to 15 years. Take that and multiply it across global auto production. We're looking at roughly 80 million vehicles produced per year globally. If even half of those transition to EVs over the next decade, you're talking about an additional 2.4 million metric tons of copper demand just from the automotive sector alone. But it doesn't stop there. AI data centers are the new wildcard that nobody was pricing in 5 years ago. A single large-scale data center can require anywhere from 5,000 to 10,000 metric tons of copper for cooling systems, electrical distribution, backup power, and high-speed interconnects. And we're not building 1 or 2 of these. We're building hundreds. Microsoft, Google, Amazon, Meta, they're all in an arms race to build AI infrastructure. And every single watt of computing power they add requires copper to keep the system from literally melting down. Then you have renewable energy grids, solar farms, wind installations, grid-scale battery storage. All of it is massively copper-intensive. A single offshore wind turbine uses approximately 8 metric tons of copper. A solar farm uses about 5 to 12 metric tons per megawatt of capacity. The International Energy Agency has projected that to meet global climate goals, we need to triple renewable energy capacity by 2030. That's not an optimistic forecast. That's the bare minimum to stay on track. So when you add up EVs, AI data centers, renewable grids, and baseline industrial demand, you're looking at a multi-decade locked-in demand profile that hasn't existed in human history. This isn't cyclical demand that goes away when the economy slows down. This is structural demand that's baked into the infrastructure requirements of modern civilization. Now let's talk about the supply side, because this is where it gets really uncomfortable. New copper mines take 12 to 15 years to come online from discovery to production. That's not an exaggeration. That's the average timeline when you account for exploration, permitting, environmental reviews, financing, construction, and ramp-up. And here's the kicker. Ore grades have dropped 30% since the year 2000. What that means in plain English is that mining companies have to move 30% more rock to extract the same amount of copper. The easy, high-grade deposits have already been mined. What's left is deeper, lower grade, and more expensive to extract. So not only does it take longer to bring new supply online, but each ton of new supply is more capital intensive and energy intensive to produce. Let me run a simple stress test for you. Let's assume global copper demand grows by just 3% per year. That's actually conservative given the electrification trends we just discussed, but let's use it as a baseline. 3% annual growth on current demand of roughly 25 million metric tons per year means we need an additional 750,000 metric tons of new supply every single year just to keep pace. But here's the problem. There aren't enough new mines in the development pipeline to meet that growth. According to the most recent data from S&P Global, the copper industry is facing a cumulative supply deficit of nearly 10 million metric tons by 2030 if current trends continue. 10 million metric tons. That's not a rounding error. That's a structural gap that cannot be bridged by incremental efficiency improvements or recycling alone. The strongest case. Against. This let me pause here and do something I think is absolutely critical. I need to steelman the strongest argument against this entire thesis, because if I can't defend against the best counter-argument, then I'm just another talking head pumping hopium. Here's the strongest case against everything I just laid out. Recession will kill demand. And I'm not talking about some shallow 6-month slowdown. I'm talking about a prolonged global manufacturing recession where the PMI stays below 50 for an extended period. If that happens, the argument goes, copper's so-called supercycle is just a debt-driven mirage. All this talk about EVs and AI data centers and renewable grids assumes continued economic growth and massive capital investment. But if credit conditions tighten, if corporate balance sheets come under stress, if governments pull back on green infrastructure spending, then all that projected demand evaporates. And copper, being a cyclical industrial metal, would get crushed. This is the bear case, and it's not a straw man, it's a legitimate concern. So let me address it directly. First, let's acknowledge that yes, copper is cyclical. In a severe recession, demand would absolutely take a hit. I'm not going to pretend otherwise. But here's where the traditional cyclical playbook breaks down. The direct corporate deals prove that tech giants don't care about the PMI. They care about availability. Think about what AWS is doing. They're not speculating on copper prices. They're not trying to time the cycle. They're de-risking their supply chains because they know that if they wait for prices to crash and then try to secure supply, the supply might not be there. This is the key insight that separates this cycle from previous commodity booms. In past cycles, demand was fungible. If the economy slowed down, you could defer projects, delay construction, wait for better conditions. But the infrastructure demands driving copper today are not fungible. They're not optional. If you're Amazon and you need to build a data center to support your AI services, you can't just delay that project indefinitely. Your competitors are building. You're either securing the copper you need now or you're falling behind in the AI race. If you're an automaker and you've committed to transitioning your entire fleet to EVs by 2035, you can't just pause that transition because the economy hit a rough patch. This is what I mean by locked-in demand. Could a deep recession slow the pace of that transition? Sure. Could it delay some projects? Absolutely. But it can't eliminate the structural need for electrification, what I'm watching next. So now that we've laid out the thesis, run the math, and addressed the strongest counterarguments, let's talk about what happens next. First, I'm watching the LME closely for any changes to margin requirements. When physical inventories start declining and volatility increases, exchanges typically respond by raising margin requirements for futures contracts. If we start seeing margin requirement increases at the same time that shadow withdrawals are accelerating, that's a signal that the paper market is coming under stress. What do I mean by shadow withdrawals? The LME reports inventory levels, but those numbers only tell you what's sitting in registered warehouses. They don't tell you about the copper that's being pulled into private corporate stockpiles through direct offtake agreements. The AWS deal, the copper isn't going to show up on the LME. The Samsung deal, not on the exchange. So you can have a scenario where official inventories look stable while the actual available supply for spot transactions is evaporating. Here's the dashboard I'm personally monitoring. Number 1, LME inventory levels. If these continue to drop while corporate direct offtake deals are rising, that's confirmation that the squeeze is moving off exchange. Number 2, the $5.50 floor. If copper holds above $5.50 per pound during the next broad market sell-off, that's confirmation that the decoupling is permanent. Number 3, the spread between futures and physical premiums. If you start seeing physical premiums widen significantly above futures prices, that's a signal that the spot market is tighter than the paper market is pricing in. None of this is going to happen overnight. This isn't a GameStop-style short squeeze that explodes in a week. This is a multi-year structural trend that grinds higher in a way that most people won't even notice until it's already happened. The price could chop around between $5 and $6 for months. It could even pull back to $4.50 if we get a sharp recession scare. But the underlying fundamentals don't change based on short-term volatility. My personal battle plan. All right, so now I need to be very clear about what I'm doing personally with this information. This is not advice. This is not a recommendation. This is just me sharing my own triggers and how I'm navigating this setup. I'm watching the copper to gold ratio daily. If it continues to turn higher while silver is being suppressed or range-bound, I am personally rotating my focus from precious metals to industrial tech metals. That doesn't mean I'm selling all my physical silver. That's my insurance. That's my long-term wealth preservation. But in terms of where I'm looking for asymmetric upside over the next 12 to 24 months, I'm shifting attention to copper exposure. Here are my specific triggers. Trigger A. If copper closes the week above $5.80 despite a broader market sell-off, meaning stocks are down, precious metals are down, but copper is holding firm, I'm looking to increase exposure. Why? Because that would signal to me that the structural bid is real, that the institutions are defending this level, that the decoupling is confirmed. Trigger B. If copper breaks below $5.20 on a sustained basis, not just a one-day flush, but a clean weekly close below $5.20, I'm sitting on my hands. That would signal that the China drag is temporarily stronger than the AI boom, that recession fears are winning out, and I would wait for a new base to form before re-engaging the final forecast. Let me bring this home with a 3-sentence recap. Silver is the headline, but copper is the quiet chapter that comes next. The AWS and Samsung deals are the first drops of a coming corporate tsunami where tech giants bypass public markets entirely to secure strategic supply. The macro rotation from precious metals to industrial tech metals has already begun. The market just hasn't announced it on the ticker yet. Over the next 12 to 18 months, I expect copper to grind higher in a way that frustrates both bulls and bears. It won't be a clean, dramatic rally. It'll be choppy, range-bound price action that slowly builds a higher floor. But underneath that surface chop, the structural forces are aligning. Corporate supply chains are tightening, LME inventories are declining, new mine development is stalling, and demand from EVs, AI data centers, and renewable grids is accelerating. At some point, the paper price will have to reconcile with the physical reality. And when that reconciliation happens, it won't be gentle. I'm not saying copper is going to $10 per pound tomorrow. I'm saying that $5 per pound is the new floor for a world that has no choice but to electrify. Don't let the red flush on your screen blind you to the tectonic shift happening beneath the surface. The era of copper is just another industrial commodity is over. The era of copper as strategic tech gold is here. And while the mainstream media is writing obituaries for the metals mania, the smart money is hardwiring the future with the one metal that can't be printed, can't be synthesized, and can't be substituted. You can ignore it. You can wait for confirmation from CNBC. You can tell yourself this time is different and the supply deficit is overblown. Or you can look at what AWS is doing, what Samsung is doing, what every major tech company building the AI-powered electrified future is doing. They're securing copper directly off exchange at above market rates. They're not speculating. They're not trading. They're acquiring a strategic resource they know they cannot afford to be without. The question you have to ask yourself is, are you going to position for the world as it was or the world as it's becoming?